Hello, it's David and Brent joining you. Today is Wednesday, March the 18th. Brent's put together a little bit of a PowerPoint he's going to walk us through, talking about the crazy times that we're facing with respect to Corona and the markets and the market responses. So, Brent, I'm going to let you walk us through this. You've captured a lot of ideas of your own, and we've talked about this a lot. So, what have you been thinking about?
Yeah, David, it really is crazy times, and I think it's one of these times we often talk about that um, you know observe, orient, decide, and act kind of framework. And right now, things are changing so fast. I mean, just in the last couple of weeks, we've had the Fed lowering two emergency meetings. We're talking about $1 trillion of stimulus. I mean, it's really going crazy, and the reason it's going crazy is because of the COVID-19 coronavirus outbreak. The World Health Organization is saying 191 cases as of this morning. I recorded this actually once earlier last night, and Zoom is so busy that we've saved it and they haven't gotten it kind of processed yet in their cloud, so we're putting it onto our computer so we can get it out to people. So I mean, it's just absolutely insane what's going on right now. So let's go ahead and go through. I mean, we could talk about the virus numbers and what's going on and what people are thinking about that till we're blue in the face. But I think you and I have shared that Howard Marks memo back and forth. Nobody knows. And I think that's still the case. Nobody really knows exactly what the death rate is, what the transmission rate is, how many people have actually had it. I mean, there are just so many questions right now in that space. What do we know? We know that the economic fallout from this is and will be absolutely massive. Okay. And the reason, and it's actually kind of hard to even get your head around it, because there's two things going on from an economic standpoint. We have both a supply shock and a demand shock. And global supply shocks are very rare. I mean, it's just really hard to even go back and find a supply shock of this magnitude. And the example I saw the other day, that probably the most reasonable, is the Arab oil embargo, a long time ago. And the supply shock is the one that people, I think, don't understand as well. What that's a result of is just factories not being able to produce stuff, not being open, movie theaters not being open, restaurants not being open. It doesn't matter what you want to pay for it. There's no supply. And my own example, I'm waiting on some ag equipment for my farm. I think it's very unlikely I'm going to get it in time to use it for spring fertilizing season, because they just can't get the parts. They're not coming. And so, you've got a supply shock, and then you've also got a demand shock because consumers are not out. They're not buying stuff. They're scared. And so these things kind of reinforce each other. Demand shocks are usually easier for, certainly for the Fed to deal with, than a supply shock. And we'll talk about that more in a second, but the impact of lowering interest rates has almost, no impact on a supply shock. We'll talk about that a little bit in a second. Second, we've seen huge drops in economic activity. I'll show you a couple things on that, but it doesn't take a rocket scientist to see that. We're starting to see serious talk of support for all the impacted industries. And the question here is just going to be, where do you draw the line? Who gets help? Who doesn't? How much help? What does the help look like? Because, for instance, if we want an airline industry in this country, given the measures that are what's been going on, we're going to have to support it from a government standpoint to keep them alive. The fiscal stimulus is coming. That number keeps changing a lot. The question I have is, will we get enough? I mean, I had a friend the other day that said, I said, well, we're probably going to get $1 trillion. He's like, that's not even close enough. We need 2. I'm not sure 2 is enough. It's just, it's a big hole. Monetary policy is somewhat ineffective in this, but lots going on. There is one area of monetary policy is very, very important. That's to keep the credit markets functioning. We do not need this supply and demand shock to turn into a financial crisis. So in the housing crisis, we got a financial crisis, and it caused all kinds of problems. Here we've got demand and supply shocks that could lead to a financial crisis, which we don't want. And so it's very important the Fed does things to stop that. We need some kind of financial market stability. But as you'll see, I mean, it's just absolutely crazy. And you're going to see more and more credit issues coming out. And we'll talk about that more. Regardless of how you think the viral situation is going to play out, and I've seen all kinds of things suggesting both ways, and Dave and I were just talking about this a lot before we went on air. Lots of different scenarios are possible. The bottom line is the economic damage is massive already. David, you want to say anything, add to that? Or
I would add that with respect to the federal government response, that fiscal stimulus, I think we're going to see multiple waves of that. I don't think we're going to see a one and done type bill. This is a very live event, and so they're trying to respond as the conditions change. And then I would agree that economic damage is sort of already there, and it's very real. And the question that we got to think about is the duration. So now we the magnitude is unknown, other than that's huge, but we're going to start to watch duration of this as we move forward.
Right. Okay, let's go to the next one. This is just some interesting data from Open Table. It's their change in dinars. They've made this data public. I got this off a Calculated Risk blog, which is a good site to go if you want economic data and some commentary on it. And you can just see the plunge in year-over-year change in dining starting basically the start of March, now down 65-70%. I mean, this is just indicative of one industry out of, tons of them, just massive declines in economic activity. Okay. So the other thing I want to talk about for a second is just the situation with the Federal Reserve. And what you have here is their balance sheet, total assets, okay, on the Fed's balance sheet. And what we can see is that, for a long time, that number is pretty stable, right? It bounced up and down a little bit, but all the way into the financial crisis, it was pretty stable. And then the financial crisis hit, and the Fed had to do something that was actually quite controversial at the time. They had to buy a whole bunch of junk, assets that nobody else wanted because financial markets were imploding. They put them on their balance sheet and drove it up to, at the time, a massive $2.3 trillion. Some of them came off. The economic recovery was really slow, didn't come. The Fed said, we're at the zero bound on interest rates. What we're going to do is we're going to do quantitative easing. They started buying longer term bonds, pushed that balance sheet up, and just kept going, okay? And then we got to the point where, our economy actually started to recover. And the Fed, kind of held it constant. In fact, in 18 decided, we're going to start withdrawing some of this stimulus we've provided, and we're going to let those assets kind of run off. So as the bonds mature, we just retire them, and we don't reinvest the proceeds into the bond market. And so they started shrinking the balance sheet. Okay, this is just recently, okay, 2019. And then something happened. We started to see problems in the repo market, the overnight repo market, and the Fed said, we've got to kind of pump some of that back in. And so they started increasing their balance sheet again, right up to, the outbreak. And now that balance sheet is already committed to be way up into this space, okay? So we're in very uncharted territory. And this thing is going to expand bigger and bigger all the time because they have to keep the financial markets functioning. Go ahead. Now, the other thing at the same time, our economy is actually running very good. We're going to go from nearly record employment to massive unemployment. I mean, Mnuchin was out the other day saying 20%. And we're going from super tight labor markets to labor markets where nobody has a job. And the federal government, part of the reason the economy has been doing pretty well is we've been running a pretty big budget deficit. So the Fed has been accommodative with interest rates. And part of the reason they had to be so accommodative because who is borrowing a lot of money right now? The federal government. These are kind of, our tax cuts impact on the deficit. Now, the good news is, we're talking about $1 trillion stimulus packages on top of this. So we're going to run that sucker way down here, okay, way down there off the chart in order to try and get this thing going back. Oops, let me clear these. David, is there anything? David, jump in anytime.
All right. No, keep going.
Okay, let's go to the next one. Oh, this is just the Fed's, our deficit is a percent of GDP. The good news in all of this, okay, is that that number in this was only, was less than 5%. It's going to be way bigger than that now because one, GDP is not going to be growing. It's probably going to be shrinking. And this Fed spending is going to get way bigger. Okay, let's go to the next one. And the reason it's got to get bigger is this is our economy, okay? Personal consumption expenditures, 64% of the total. Okay? And it varies a little bit, as you can see. Net exports on the bottom were actually net importers, so they are a little bit of a negative toward GDP. Gross private domestic investment is in purple. That's this one. That's about 16%. And then government expenditures are 16%. Right now, what's the only one that can expand? And it's got to be this one, government spending. And that's what's going to happen to try and prop up the economy. So let's go forward. The other big thing that's going on right now is this oil price war. Russia, Saudi Arabia, in the face of a demand shock. So OPEC meets, they decide, we would like to cut oil production because we can see demand is falling rapidly. I mean, you see pictures of Beijing and those cars on the street, oil demand's falling pretty rapidly. Airlines aren't flying as many miles. I mean, it's just, tanking. And Russia said, we don't think this is fair. We would like to pump more oil. We're tired of taking your guys' cuts. Saudi Arabia said, okay, we'll just pump more. Let's see how you guys like that. And oil prices plummeted, okay? Way down into the 20s. I didn't look today to see where they're at. Just tanking.
Down again today. I think 18-year lows, I believe, is what I saw.
18-year. Yeah.
So the interesting thing here, I think, is that OPEC as a group wanted to shrink the size of the pie to keep their prices up. So the pie being output and hopefully managing their prices. And Russia and Saudi Arabia got into an argument as to who got a bigger slice or whose slice of the pie was going to change a month. And Russia said, yeah, you can cut production, but we want to have the same amount of output. So we want to actually have a bigger slice of a smaller pie. And that didn't go well. So it's a very interesting strategy. It's one of these, I think the challenge here is we have cascading events. So we have the COVID-19, and then this is just an event that is mostly unrelated, but then it fits into the narrative very tightly. And so you add a demand shock to the oil markets, this sort of fight, and the whole thing sort of blows up right in front of our face.
Yeah, and so I mean, the thing to think about from the American side is, we're used to saying, oh well, it's lower gas prices, probably stimulative the economy. The United States now a major oil producer, so this is a big negative for us as well because this whole industry is in turmoil because these numbers are probably well below cost of production for most American oil producers, which was part of the argument that OPEC was having. You've got to think that eventually they're going to come together on this and take some production off the table. But who knows at this point, and who knows how bad the demand shock is going to be. But this has a lot of, you know, when you get moves of that magnitude in these markets this large, it creates there's just lots of events that can happen in terms of financial problems, other things that are really hard. So if you have a bank or bonds issued to oil companies, they're not worth nearly as much as they were. In addition to all the other ones you have are not going very well either. So it can create lots of kind of financial repercussions that are very hard to understand, foresee, and know exactly how it's going to play out.
Yeah, I don't think there'll be any additional oil. A lot of oil investments going in at this price level, especially in the U.S. and those shale producing regions. They need it closer to $55 or $60 a barrel there. So it's just a huge adjustment. It's hard to tell the scale here, but this is a 6-month graph, and so we were at 60. We were above $55 a barrel for most of this time frame, and now we're at it's more than a 50% decline over sort of this 6-month average. It's a huge, massive. That's what we've been seeing is these 30, 40, 50% adjustments in some of these commodities or asset classes.
Yeah, this comes back to our favorite cartoon, which is the guy watching. He says everything that was good for the market yesterday is no good for it today. And boy, we've seen that play out in spades here in the last few days, because what we've seen is a series of way down moves, then some rebound, then some more way dramatic drops lower, mostly lower. But there's just so much volatility right now, and part of it is we're operating right now at what I would say is peak uncertainty. Okay, we may have come a little bit off of peak uncertainty. I think that was maybe a little while ago where people really hadn't quite figured out what was going on. Now we know the economic impact is big. It's just a question of how big. But until this uncertainty starts to resolve, you're going to see all kinds of stuff for which this cartoon is perfectly appropriate.
I remember the first Federal Reserve emergency meeting now almost 2 weeks ago. We saw this rate cut, and the market was lower. Then last weekend we had this rate cut to zero, and the market opened lower. And so it's this idea that usually this information would be supportive to the market, but it's been bad news when it comes out.
Yeah, it's just uncertainty. What do they know that we don't, and how bad is it? And these are S&P 500. You can see, massive declines here. I don't want to belabor that, but what I do want to talk about is just this kind of, that's uncertainty just kind of rearing its head, and the market is trying to recalibrate, all of their earnings expectations for the future, trying to understand, financially what's going on with these companies, and it's hard to know. So let's go to the next one. The Fed has basically shot its gun on terms of the Fed funds rate. And you can see this is just really interesting to see how rapidly things have changed. Went through 15, 16, we started seeing rates finally come off the zero bound. This is the upper limit of the Fed funds rate, which means right now we're 25 basis points, basically means 0 to 25 basis points. Up, economy is improving, getting better. Trump probably started complaining about the Fed somewhere, in this range. Powell started lowering interest rates here, and here's emergency rate cut 1, here's emergency rate cut 2, and it's the impact of this in the short-term market right now, I think, is basically zero. It doesn't have much impact other than to say the Fed's going to take that off the table as a reason to complain about anything. But it's not going to stimulate a lot of growth right now. Okay. The other thing we got to remember is the right now part, because normally in a supply shock, you wouldn't want to lower rates because that could lead to some price inflation with the supply shock, but we got such a big demand shock, it's really hard to sort out. So for now and for quite a while in the future, you can expect these to be low.
Just for context, 12 months ago, we were talking about an environment with higher rates of interest. So higher interest rates was the story 12 months ago. 6 months ago, they started backing lower, and then we had these 2 emergency cuts. And in some ways, the recent emergency cuts were on the same scale, if not more significant than what we saw during the recession back in '08 and '09. So it's a really unprecedented adjustment here. And it's kind of amazing how the tone has shifted sort of over the last 12 months, but then over the last month as well. So rapid changes in this space.
Right. Okay. The yields on U.S. Treasury bonds have plummeted. So, at one point on an intraday market, the entire U.S. Treasury curve was below 1%. I mean, 30-year bonds were less than 1%. But what I want to draw your attention to is just the magnitude of this volatility out here. These are the biggest markets in the world, okay? Huge debt markets and just so much volatility. And it's just, consistent with what's going on.
And so this is what the Federal Reserve was looking at, right, Brent, whenever they stepped up earlier this week and they talked about sort of adding to the balance sheet. This is the area that they were focusing on.
Yeah, I think what they said is they're going to buy bonds and mortgage-backed securities to try and alleviate some of the problems. What they were seeing is the bid-ask spreads in these markets had really widened beyond what they normally should, as nobody wants to make a market at this point. People are worried about, where they're going to get cash and what they're going to do with cash. And so, the bond markets really need to function. And the Fed basically said that they're going to make sure they function. So they're going to put as much money into it as they need to make sure they function smoothly, which is good.
So let's talk about the ag situation a bit.
Yeah, so the ag situation. Here we go. So here's agriculture in the midst of all this stuff, right? And what, I guess, a couple things to just, I think it's important every now and then we just have to step away from all the craziness and look at what is the actual fundamental supply and demand situation. So what we have is a stocks to use ratio for corn and blue, soybeans and red, and wheat and green. And for 20, we use the Ag Outlook Forum data. So these aren't from a WASDE per se. This is WASDE data here, but the World Ag Outlook Board, this is from the Ag Outlook Forum. Okay, so it's usually a little different number. They use their projected plans. We'll get an update here pretty soon on prospective plannings, so we can start to get into this more. Now, what you see in blue is that, given normal kind of demand, for instance, with corn, what they were saying is that, look, we think stocks to use ratio is going to expand. Okay, now the problem, I think two things we have to be concerned about. One is, what is this use going to be going forward with, the oil prices where they're at, miles driven falling, how big of an impact is going to have on the ethanol industry and on demand export wise as well. Beans actually, though, their situation actually improved over 19, and wheat has actually improved. So in my mind right now, there's still lots of uncertainty. We don't know what farmers are going to do. We frankly don't know what the planting situation is going to be like. There's weather issues that I think we need to think about, and I don't want to talk about the virus a whole bunch, but we have to at least admit that there's some potential for, these supply chain problems and health problems to impact planting going in 20. So this number, I think, is hard to know exactly where it's going to be. But if you start to see stocks to use get into this range, that's not very bullish for corn. Okay, and so we're gonna have to watch, what plan intentions actually come out, and watch the plan progress very carefully. If we were to grow an above trend crop, I mean, this, regardless of the virus situation, price outlook wouldn't be very favorable. On the other hand, if we're to have the kinds of problems we had last year with planting, we can get in a situation where we see quite a bit higher grain prices. Now, how high is a whole nother question, but I think this whole thing, we have to remember to kind of keep this in mind in these times of panic, and think rationally through it, and think about where things are going.
And as a result, grain prices have really adjusted. So we've been following the December 20 corn futures Spent some time around $4 a bushel at the beginning of the calendar year. Now, I think if we looked at it today, it's even lower, somewhere around that $3.58 a bushel. Big adjustments here.
Yeah. So, you have taken what, David, $90 an acre
90 to $100, yeah, 50 cents
out
right
of
off.
the grain
Yeah.
markets. Okay. At least. Okay. At least.
Uh,
And for some producers, in the heartland regions, maybe even more than that, I think it's going to be a real question as to. I mean, I was telling somebody the other day. I mean, this is not actually a massive move. I mean, it went from 4 to 360. That's a 10% move, and corn is not off the charts big. Okay, but I think in this tight margin environment, these are prices that aren't going to work very well for a lot of farmers. You have to wonder, how that's going to impact plant intentions. But the other hand, soybeans haven't fared much better, right, David?
right. Another significant walk back. 920 beginning of February, which has been the lowest they've been trading in quite a while. They got up to 980 before. Now looking at 840 or a little bit lower. So another 60 cents or so coming out of that market again.
And I think that 840 is right in there with the lowest that we saw even at the height of the trade war, right?
Yeah. It's a big adjustment here, and as we talked about earlier, it's a big adjustment on a not good starting point, and so it's just a tough outlook as producers start to go make their planning, and a lot of times, in a lot of cases, it's a big update from where we made our initial budget projections just a few weeks or months ago.
Yeah, and I think when you look at the ratio of those two prices, neither this move hasn't favored one or the other. I think they're equally kind of. The market isn't making a big statement right now, in my opinion, as to which of these commodities it wants.
None of the above, I guess, is sort of
Yeah,
its response.
yeah.
And cattle's had a really rough adjustment.
Yeah, and I mean, just look at this volatility. The intraday trading range on the other day was what, from 100 down to like 92 or $8 range in the day. It just massive volatility, and lots of reasons for it. I mean, so this sector is pretty exposed to bottlenecks that would come from supply problems at, say, the packers, with disease outbreaks, packer shutdowns. They're not 100% perishable cattle, but you sure don't want to keep them any longer than you have to, and they kind of stack up. And so, it's you've got that going. We've got labor problems, I think, in all of agriculture staring us in the face. Probably tightening the borders more than we have for a long time. So getting people in. I was talking to another farmer the other day that was looking for H2A help, and they're not getting here. What are custom harvesters going to do? I mean, if you're familiar with the custom harvesting industry, huge amounts of H2A workers in that industry. If they're not here, it's a little bit of a problem. And so, there's just tons of questions everywhere you look.
So the thing that I'll add to this is, if you look back at consumption, per capita consumption of meats, the red meats, chicken, pork, these were really impacted back in the recession, 2008, 2009. And so I think thinking about where the next year or 18 or 24 months in these markets, probably a lot more exposure to that income, that consumer spending that Brent talked about really early on. There's going to be a lot of exposure here for this particular market. And so it's going to be one to keep an eye on. In fact, beef had a long recovery here. So per capita consumption dipped. And I believe around 2015, it started barely just to recover, and it barely got back to those pre-Great Recession levels. And so, again, we don't know what this recovery here is going to look like. We don't know how long the slowdown is or what the recovery looks like, but I think a lot of this price adjustment is also expecting consumers, if they have less income, they're going to be buying less beef.
Yeah, absolutely. Pork, kind of the same picture, much lower. Big drops just in the last 30 days. So
And
everywhere we look, there's problems.
the tragedy here is we were just talking about the upside potential in all of these livestock markets with respect to a trade deal with China. And so the story has definitely shifted really fast. So Brent, to wrap up, markets are chaotic and the economic damage will be or is massive.
Yeah, I think, the relief from this is not going to happen. I said anytime soon. Be a little more specific. I think we'll know a lot more about the magnitude of what's going to happen here in the next. Either the wave is going to come in or it's not on the hospital side, and we're going to know a lot more in the next 10 days. It's very difficult, I think, to sort out the ag implications. Down, $60 to $90 an acre in the last month for corn and beans. And at the end of the day, it's focused on what you control, make the best decisions possible. Is for farmers and people in the ag industries, I think, updating the budgets, understanding what your exposure is and what this has done to your financial situation, I think is very, very important to do. As well as, thinking about your workforce. Are the things you can do to help make sure you have a workforce and that they stay healthy? What can we do on parts and supply availabilities? What are the most critical things that we have? Can we get our hands on some of those right now before problems start to flare up? And I'm not encouraging anybody to hoard by any means, but I think we've got to be realistic and start looking at what how might this situation impact us, make the best decisions we can. On the risk management side, on the marketing side, on the grain side, we look at it and go, well, earlier I was fairly optimistic we'd see prices above $4 a bushel on corn on the board, pretty maybe 20 cents higher than that. And now we've got to be realistic. It's going to take some kind of a supply shock on the ag side to make that happen. Can that happen? You better believe it. But it's also, is more downside possible? Sure. So I think everybody's got to kind of reorient, observe, their situation and kind of figure out what are things they can control and work on and put in place, and what are things that aren't, because I know the news is just so negative right now. It's sometimes better to just turn it off, and we'll know more in a couple weeks, and just try and keep yourself updated but not depressed, I guess.
I think that's a really great note. I made that note as we're going through here. It's a great point to end on. It's just to recognize that if you're going to sort of grade the psyche of, as Warren Buffett would say, Mr. Market, grade the psyche of the market out there, or the thought of consumer sentiment, we've shifted really hard, really fast to this idea that nothing can go right. And every day you pick up the news, there's another list of closings, there's another sort of setback in any sort of recovery in the economy playing out anytime soon. So just recognize that there's a lot of bad news, a lot of pessimism, and sort of sentiment has shifted that way. And it's just important to recognize that. And that won't always be the case. There will start to be some positive stories to come from this. And we don't know when, but it's just important to recognize that only the bad stories are sort of coming out at this point. And not that it's just, that's where everyone's thought is right at the moment. And so at some point, this situation will begin to improve, and we'll start to see some increased activity. And stay tuned, because we're going to keep following, keep updating you. Of course, we have Brent and I do weekly comments like this on the Ag Forecast Network for our users and our followers. Encourage you to check that out. And the 30-day trial, you can get a lot of insights from that.
Yeah, and you just reminded me of that old market scorecard deal.
I was thinking about that today.
Everything, all the news is bad right now. When was the last time you heard anybody say anything that might be even simply construed as positive. It's not always going to be that way. And Dave and I were talking earlier, the one thing that it does appear to, at least to us, to be somewhat true is that the overall economic potential of the world is probably not going to be drastically altered by this disease. In other words, we aren't going to have so many people die that the overall economic potential of the world is decreased significantly. And what that means is that eventually we'll get back to something kind of normal, I think. And so, I view that as positive in the long run. It's just, how crazy does it get in the meantime? And right now, nobody knows.
Yeah, there's always a saying that you can remain in the market can remain irrational longer than you can remain solvent. And so we got to remember that sometimes this irrational behavior can play out for long periods of time.
Yeah, and there is some really bad economic news coming. I mean, take a city like Las Vegas. I can't imagine how many people are out of, unemployed now. And I mean, there are some real awful things happening right now in the economy. It is really apparent. Eventually, though, I think things will turn around.
All right. Well, that's all for us today. Thanks a lot for joining us. Stay in touch. Let us know if you have any questions, comments, or feedback. As always, we appreciate you joining us, and happy forecasting.